Very good. Okay. Well, welcome everyone. Thank you for joining us today. Oh, my reminder link came up. We're very happy to have you. For those that don't know, my name is Su-Ling Ching, and I'm the President and CEO of the Ottawa Board of Trade. We're very pleased to be offering a series of webinars to assist our businesses in gaining some information, maybe some inspiration and ideas for innovation as we move forward, navigating the impacts of COVID-19 so that we can start to look at what a rapid rebound could look like as well. So we're very grateful to our members who have supported our initiative, including the Ottawa Citizen, who's a community partner, Enbridge Gas, our technology partner, Media Mall, and of course, today's presentation partner, Welch LLP. Just a few updates on the Board of Trade as we enter week 5, essentially week 5 for Ottawa. It's been an evolving situation, to say the least. We've spent most of our time at the Board of Trade really doing what we've always done in terms of advocating on behalf of business, looking for ways to create prosperity through collaboration and leadership. And, but of course, it's taken on an all new meaning. And so we have been in very deep and numerous talks with our members, with business and community leaders and officials at every level of government, trying to ascertain what can be done to support our business economy and frankly our community at large, and putting that information forward to the government, looking at programs that they've been able to develop, and then how that's fitting into the needs of our business community and going back and tweeting. So it's been just an evolving conversation, and you know, one little tagline we've created over the last few weeks is conversations create change. So all of us, it's been the great equalizer, because we're all new here, and we're all trying to navigate what we can do to support each other until we come out on the other side. We hosted a fantastic town hall meeting this morning with 3 representatives from 3 levels of government. And so that's what we continue to do, is advocate on behalf of our business community, and then continue to bring benefits forward, including all of our affinity programs are still running and helpful to help our businesses reduce costs. And I want to say thank you to Lynn Ladd from our team for creating this new webinar series, which has been very popular. And today we're very excited about the review of the government assistance and tax-related measures as it relates to COVID-19. So without further ado, I will introduce our very esteemed presenter today, Jim McConnery, who is a tax and estate practitioner with a wide-ranging expertise on tax acquired through 25 years of public accounting. Jim provides assistance to individuals and private companies with a particular focus on tax, estate, and succession planning. A key aspect of his expertise relates to tax minimization strategies via family trusts. This includes income splitting strategies and multiplying access to the lifetime capital gains exemption. Jim also provides support in the context of the purchase or sale of private company groups. Jim assists corporate groups with both inbound and outbound structuring assignments. This includes planning to minimize tax with respect to foreign income and steps to minimize tax incurred when income is repatriated. Jim also oversees compliance assignments, which include withholding tax and foreign tax credit matters. He provides planning assistance to individuals with respect to both immigration and emigration from Canada. Jim joined Welch in '94 after graduating from the University of Ottawa, where he received a Bachelor of Commerce degree with honors in finance. He received a CA designation in '97. He was with a national accounting firm tax group for 10 years and then returned to Welch in 2007. He's been involved in educational programs for both CPA Canada and CPA Ontario. Jim is also a very active and supportive member of the Board of Trade. Thank you very much, Jim, for being here with us today, and we look forward to your presentation.
Thank you, Su-Ling. I'll share my screen. I want to make sure I've got the right screen up.
Perfect.
There we go. And I just want to move a second screen where I can see the notes to my presentation.
I think we'll all be able to go into tech support after this, eh?
You're right. There we go. Thank you very much, Sue Ling and Lynn. Thank you to the Ottawa Board of Trade. I think it's a great opportunity for me as a practitioner to share insight about some of the government assistance and tax-related measures that are helping the business community deal with the COVID challenges. It was interesting, Sue Ling, when you were providing a recap of my bio, a lot of the things that I have expertise on in my traditional area of focus are less applicable right now. But it definitely is the case that myself and my colleagues at Welch are keen to help our clients, both business owners and individuals, navigate the challenges. It's definitely a very unique time for the business community and for the economy in general. And I think we're dealing with things that we don't normally deal with. I'd say as a general summary, the government measures, I think, have been proactive. In some cases, they've definitely been reactive to the circumstances that have evolved fairly quickly. The one area that I think is a challenge for accounting firms, advisors, and business owners is that the programs and the announcements are moving relatively quickly. We are doing our best at Welch to stay up to date on the various programs, but it's definitely the case that it's an evolving situation. So it's important for business owners to stay on top of the various measures.
Jim?
Yes?
Jim, I just wanted to let you know we're not seeing the correct screen.
Okay, what are you seeing?
Slideshow, resume slideshow.
There
we go. Perfect, thank you.
You've got it now, okay.
Yep.
So since mid-March, we've been helping, or ourselves evaluating and helping our business owner clients navigate this new landscape. This presentation will focus primarily on business-related measures, tax-related measures that are relevant for business. Separate from that, and primarily a focus on the federal programs, I will talk a bit about Ontario, but the focus is primarily on the federal programs that are available right now. Separately, my colleague Candace Enman had a presentation with the Ottawa Board of Trade. I believe it was earlier this month. Her presentation will be interesting to business owners as well if they've not already seen it. Candace definitely is helping business owners understand the challenges that arise currently, a focus on how to predict, forecast, and manage cash flow, and then some good insight on some of the various loans and financial programs that are available primarily via support provided by the federal government, with some of the loan programs administered with the help of the EDC and the BDC. I'll have a link to Candace's presentation later in my presentation, but it's a good source of information, focus more on the internal financial matters that companies are doing their best to navigate. Just a bit of background about Welch. Welch is an Ottawa-based accounting firm. We also have an office in Toronto. We are in a number of smaller markets in Ontario, and then we have one office in Gatineau. Welch definitely has a focus on the small and medium-sized enterprise, focus on the business community and business owners. So let me show you the outline of what is in my presentation. Here is the recap of what is in the presentation. By far the bulk of my presentation will be on the 75% wage subsidy, which is known as the Canada Emergency Wage Subsidy Program. It is, I would say for most business clients, it's probably the most substantial form of government assistance available. Ideally, it applies to most employers, and ideally it allows employers to keep employees employed throughout the COVID challenges. So the details, there's a lot of details there, and as we discussed a bit earlier, some of the details are in a state of evolution. We had some more detailed information just within the last few days, so we'll talk about that program in a fair amount of detail. There's a 10% wage subsidy that was announced very early on. It was announced in March 18th, I believe. It has a lower potential dollar value in terms of savings or potential assistance, but it's a program that will be relevant to some employers as well. Recap briefly on the federal loan programs that are available to provide assistance to government, to companies. Recap of some Ontario government support programs. I'll have an outline of some additional sources of information from Welch and other sources. I would say though, most of the accounting firms and other similar organizations have a lot of information available. The government as well has some good sources of information, so I'll provide some links, but it's been my experience that information on the various programs is fairly widely available. And then we will close the presentation with some time for Q&A. So some guidance here on tax payment and filing deadlines. This was announced relatively early in, I'd say mid-March, that the government announced that there would be an extension to filing deadlines for individuals, trusts, and corporations, and also importantly, an extension to payment due dates for tax owing. So the tax filing deadline for individuals would normally be April 30th. That has now been extended to June 1st, 2020. One caveat is that an individual who is earning self-employment income would have a June 15th filing deadline. So, you know, a person like that is already getting an extended filing due date. But for all other individuals, instead of April 30th being the filing due date, it is now extended to June 1st. The deadline for trust returns would normally be March 31st. That deadline has been extended to May 1st, 2020. To date, there is very limited corporate filing extensions. A corporation in general must file its tax return within 6 months of year ends. What the government has announced so far is a limited extension, and it's basically for corporations that would have a filing due date either at the end of March or at the end of April. Those filing due dates have been extended, but otherwise most corporations will still have a filing due date that is 6 months after the regular corporate year end. Very common for our business owner clients to have a December 31 year end. So a corporate tax return for a calendar year end corporation is still June 30th, 2020. A more important area of relief, I think, that will be beneficial to individuals and corporations is an extension of the payment due dates for personal tax installments, corporate tax installments, and GST, HST amounts due. And the key benchmark is that it has to be with respect to a payment that was due on or after March 18th. All of those amounts, the new payment due date becomes September 1st, 2020. So that's a pretty material extension of the due date for paying amounts owing to the federal government. If we think about personal tax would have normally been owing at the end of April. So an individual with personal tax owing for 2019 can now extend the payment of that tax to September 1st, 2020. Individuals who have a corporate tax or a personal tax installment requirement that will come up in June can extend that payment to September 1st, 2020. Corporations, so a corporation with a December 31 year end that was earning active business income would have normally had a March 31 payment due date for its final amount of tax owing for 2019. That amount of tax now can be deferred to September 1st without any interest or penalties accumulating on the amount owing. GST, HST, it will depend on the nature of the corporation as to when such amounts might have been due, but with respect to any GST, HST owing after March 18, a corporation or a business can defer the payment of that GST, HST to September 1st, 2020. So those are material deferral opportunities. In a lot of cases, it might permit a corporation or a business owner to retain funds that are used in the business. The liability, importantly, does not disappear, so it'd be very important to forecast that a business will be in a position to remit the payment when it's due, but it could be an important source of short-term financing for a business. Important to note that there's no deferral of employee or employer source deductions. So where a company has ongoing payroll, they're withholding amounts from their employees for income tax, CPP, EI. Those amounts are still due on schedule based on the payroll remittance period for the relevant business. One last bullet on this slide, there might be many taxpayers, either corporate or personal, that are in a refund position with respect to 2019. It's clear that the filing due dates now have been extended. However, an individual, for example, that is expecting a refund with respect to 2019 probably would benefit from filing their tax return as soon as possible to generate that refund and have that pool of funds available. Next slide. One caveat here when we talk about GST, HST, and it's the important notion that when an organization, a business collects GST, HST, it's basically holding that money in trust on behalf of the government. So just a simple scenario, if there was a business in March that had $10,000 of taxable revenue, the HST is a rate of 13%. So that business has collected $1,300 really on behalf of the government. It's money that it holds in trust. It gets to reduce that amount owing to the government by any GST, HST that it's incurred on expenses. But all of that to say that that pool of money represents funds that are held in trust, and our tax regime has a potential exposure for directors of a corporation with respect to unremitted GST, HST, and also with respect to employee source deductions. So the nuance there is that the rules now say that you can defer the remittance of GST, HST. However, a person who is a director of a corporation may have a personal liability if those underlying funds are ultimately not remitted. So think of a business who's in a difficult financial position now. Retaining that GST, HST pool of funds provides some liquidity and some ongoing cash flow for the business. But if that underlying corporation subsequently became insolvent, technically the CRA has a claim against the directors of that corporation for the unremitted GST, HST, because that's really money that a business or an entity holds in trust on behalf of the government. We don't have clear guidance from CRA as to how they would view this situation where the corporation used the money to sustain its business activities, is ultimately unable to remit the funds. It's unclear that CRA would have a blanket type waiver for directors in that situation. So notwithstanding that GST, HST might be a pool of money available, I think businesses should be cautious about whether or not they pursue or take advantage of that opportunity. And if they do, then they want to make sure that there's a proper plan in place so that the funds can be remitted in September when they become due. The filing due dates have been extended, but it will be important for individuals and business owners to stay on track and be ready to file those tax returns when the new revised filing due dates apply. An individual or a business that has tax owing and then doesn't file based on the extended filing due dates could be subject to penalty. So that is something you would definitely want to avoid. And you would also want to forecast where you've deferred the filing of a personal or a corporate tax return. You would want to forecast the amount of tax owing and ideally ensure that the money is set aside and available to pay that liability when it becomes due. If there is money owing, funds owing to CRA with respect to tax, in general, it will be a 6% interest rate that will accumulate on that balance owing if it is not paid by the revised filing due date that applies. I don't know the answer, but given the fact that we're in an ongoing social distancing phase, it could be a possibility that the government extends the filing due dates again. So where we talk about filing due dates for individuals being June 1st, 2020, if individuals still in the month of May are not in a position where they have access to financial information or access to their accounting advisors, I don't think it would be abnormal for the government again to extend the filing due dates, but as of now, there's nothing been announced that has been announced in that regard. I'd make the comment as well with respect to tax installments for 2020, either for individuals or corporations. Those amounts in general will be based on income for 2019. So an individual or a corporation that is remitting 2020 tax installments based on the income they had in 2019 may be remitting excessive installments if it's the case that their income will be lower in 2020. So individuals or businesses in that circumstances should contemplate calculating their installment requirements based on forecasted income for 2020. So on now to the Canada Emergency Wage Subsidy. As I indicated earlier, it's the most material program available that is providing support to business. It was announced in March, and we've had ongoing updates and additional information provided in respect to the program. So in very simple terms, the subsidy available to an employer is 75% of wages paid to employees. It maxes out, so there's a maximum of $847 per week per employee. And essentially, to qualify for the program, a business must meet a revenue decline benchmark. And that benchmark in general, and we'll talk about how that benchmark is determined, but in general, it's a decline in revenues of 15% in March or 30% in April or May. The program will be in place for a 12-week period. So that period will cover March 15th to June 6th. So an employer that fully qualifies for the program could benefit from a very material wage subsidy for employees for 12 weeks of employment. Employers will also get a 100% refund for the employer share of CPP and EI for employees who are still being paid, however, not actively working. I'll talk about the 10% wage subsidy separately, but if an employer qualifies for that 10% wage subsidy, that amount will reduce the employment base that qualifies for the 75% wage subsidy. Next slide will be. So eligible employers. So an individual, so someone who is self-employed, they carry on their own business, but they have employees, they can qualify for the wage subsidy. Taxable corporations, which will include non-Canadian entities and public companies, partnerships, not-for-profit organizations, and registered charities. There's no limit as to the size of the employer, and there's no limit on the maximum assistance. When we contemplate the revenue base that determines whether or not an employer qualifies, it is contemplated in the revenue in Canada from all arm's length sources. It is based on the normal accounting method used by the employer. So that can be accrual accounting or cash-based accounting. However, once an approach has been adopted, it must be applied consistently throughout the benefit period. The revenue base would exclude extraordinary items and amounts on account of capital. So if there's sale of investments or if a business is selling some business assets, in general, that would be excluded from the revenue base. Revenues for charities and NPOs should include most forms of revenue, excluding non-arm's length revenue. I'd make a comment as well. It will depend on the nature of the company and the internal accounting they do, but I can imagine that there might be some businesses who will have a challenge in terms of assessing their revenue in the current periods and comparing that to revenue from prior periods, because it definitely is predicated on a monthly revenue reporting basis. And I can imagine that there's some businesses that do not necessarily have an accurate or detailed ongoing accounting of their activity on a month-to-month basis. Perhaps it's the case that their accounting exercise is generally on an annual basis. Companies or businesses like that might struggle a bit to determine whether or not they meet the criteria. So the subsidy details, the subsidy is the greater of, and there's a lot of nuance here. This slide has some basic bullets, but there's a lot of detail in the background, and there is some complexity with respect to arm's length employment versus individuals who are non-arm's length. So in general, the subsidy is the greater of two amounts. So it's 75% of the remuneration in the eligible period. So if in a particular week an employee has remuneration of $1,129 or more, they're qualifying for the maximum. And then the second criteria is looking at earnings in the pre-crisis period. So the average earnings might set a benchmark that is in fact going to be lower than that 75% threshold. And the effect of that limitation, it appears, is so that wages cannot be just increased in the benefit period to get to a higher subsidy amount. For an employee who is new and an employee who did not have revenue or did not have remuneration in that pre-subsidy period, they won't have an average remuneration base. So the limitation should not apply to an employee like that. With respect to non-arm's length employees, so for example, if you have a person and they own 100% of their corporation, they would only qualify for the wage subsidy if they have been employed by their corporation before March 15, 2020. There's no overall limit on the subsidy amount available to an employer. So, you know, the amounts might be very, very material for employers with hundreds or thousands of employees. And separate from that is the notion that employers will be expected to make up the best efforts to top up employees' salaries to bring them to pre-crisis levels. You know, and that definition of best efforts is not really clear yet, but you can imagine an employer that paid employees at a certain dollar value in the pre-crisis period. Remuneration was dropped significantly once the economic problems for a business might have started. So an employer in that circumstance will be expected to revert to the pre-crisis remuneration levels. Here is an outline of the periods that apply for purposes of the subsidy. And essentially we're basing it on 3 periods, which in general terms we can think of as March, April, and May. However, that claim period, for example, with respect to period 1, is the period from March 15 to April 11th. And the requirement there to qualify for the subsidy, it's all or nothing. You qualify or you don't. But to qualify there, the organization, the employer has to have a 15% reduction in revenue. And that's either revenue in March 2020 compared to March 2019, or March 2020 compared to the average revenue base in January and February 2020. The same type of format will then apply in period 2 and period 3. And an important announcement that happened within the last few days is that if an employer qualifies in a period, they automatically qualify for the subsequent periods. So if we have an employer they qualify in period 1 because they meet the revenue decline benchmark, they automatically qualify for the subsidy in period 2 and 3. So important here for businesses, I think proactively, and that period 1 is already over, it's the period from March 15 to April 11th. It would be very important for an employer who thinks that they may qualify to vet the details and ideally be in a position to substantiate that revenue decline has been met in the period from March 15 to April 11th. And that's the period, but it really is a reference to the month of March. If they don't qualify in the month of March, now next they would look to the month of April, except in April it will be a 30% decline in revenue that must be met. So that's a bit about the eligibility periods. But again, keep in mind that important nuance that it's based on the revenue of the business and whether or not the decline has been 15% in March or 30% in either of April or May. The program will be run by CRA with applications happening online via My Business Account or a web-based portal that will be launched in the near future. An employer will need to be in a position to substantiate that the revenue decline benchmark is met, and they'll also have to substantiate the subsidy calculation, i.e. that revenue base, that remuneration base that becomes the basis for the 75% subsidy. The indication is that funds will be dispersed within 2 to 4 weeks. And it is strongly suggested that employers register for direct deposit to accelerate the receipt of funds from the government. The 75% wage subsidy will be taxable income to employers, and the regime will include severe penalties for any employers who abuse the program. And that, I think, would be a scenario where, you know, the revenue decline benchmark is not met, but nonetheless, the employer applies for and receives the subsidy. So that would definitely be an abuse of the program. In that circumstance, there'd be a requirement to repay the subsidy. There'd be a 25% penalty. And in the most egregious scenarios, there could be a maximum penalty that is 225% of the subsidy and 5 years in prison. So, you know, the government is rolling out this program. The program is relatively flexible, and it's, you know, it's meant to provide that targeted support to employers, but at the same time the government is concerned with people who abuse the program, and there's a severe penalty regime that could apply. Separate from the 75% wage subsidy, very early on in the COVID crisis, on March 18th, there was a subsidy announced to ideally allow employers to get some additional liquidity and mitigate layoffs. The program had a much reduced dollar value in terms of support, and it essentially 10% of remuneration to a maximum of $1,375 per employee and an overall employer ceiling of $25,000. This program, it's already in place, so ideally some employers have taken advantage of this program, and you essentially benefit from the cash flow vis-a-vis an opportunity to reduce the source deductions that are remitted to CRA. So if in a particular period an employer, based on the calculation, would have benefit of $5,000 from this program, that employer would be allowed to reduce the source deductions that they remit to CRA by $5,000. So there's sort of an automatic way that the funding support is available to employers. This subsidy, though, had, you know, a smaller potential dollar value to employees, but also a more narrow range of employers that could qualify for the subsidy. And it was essentially limited to entities that qualify for the small business deduction. And that, in general terms, would be a Canadian-controlled private corporation that carries on an active business in Canada. So, you know, it was not available to partnerships. It was not available to non-Canadian companies. not available to public companies. So a more limited scope of application. The subsidy, this subsidy as well is taxable income when received, not available for non-arm's length employees. And this subsidy could be, you could have a corporate group that could include several entities, several corporations. The corporations would generally be available to, could be available to more than one corporation in an associated company group. And again, so a 10% ceiling, a more limited dollar value, however, no sort of revenue type test for the eligibility for the credit. And now just moving a bit quicker through the remaining slides. Candace Enman, you'll see at the bottom of this slide, had a presentation that addressed the various loan programs available from the government. Some of the programs are administered in partnership with the BDC and the EDC, and some of them have a very material dollar value, but they definitely have a fairly complex process to apply for the loans. And the Candace has a bit of additional insight on the criteria that would be used to evaluate the availability of the loan. So, you know, these are not subsidies, these are loans that might be available to a business. And generally administered by the BDC and the EDC. The second part of this slide talks about a smaller loan program. It has a $40,000 loan value. And to qualify for the loan, a business had to have payroll in 2019 between $50,000 and $1 million. It's an interest-free loan. And if the loan is repaid by December 31, 2022, then 25% of the loan is forgiven. So that might be an interesting program to provide some limited short-term financial support. Smaller dollar value, but an interesting loan opportunity to businesses that may qualify. I've got the link on this slide to Candace's presentation that has much more detailed information. So you can find that vis-a-vis the website of welchcapitalpartners.com. And Candace's contact information will be on there as well if people have more questions. Here's a basic recap of the various Ontario programs that provide some support to business. Employer health tax, there's an increase to the exemption limit, which is normally $490,000. So for 2020, that exemption limit is increased to $1 million. So that means there's more Ontario businesses that will not incur EHT in 2020. There's a deferral opportunity with respect to the remittance of WSIB premiums. There's a deferral of certain provincial type taxes in terms of remittance due dates and filing deadlines. There's an extension of the Regional Opportunities Investment Tax Credit Program. I think Candace had more information on that in her presentation. And then finally, a relief to electricity costs in Ontario. This is essentially automatic because the reductions flow through on Ontario electricity bills. Here is a recap of what I consider to be some helpful links. 3 sources of information, but I would tell you there is a myriad of different sources of information available. But the government of Canada has some up-to-date and ongoing information being provided with respect to their response to the COVID. The BDC has some very good materials related to private business. And then finally, Welch on our website has a section devoted to COVID type matters and COVID type publications that we prepared. So that was it for my slides. I'm definitely glad now to engage with the group on some Q&A. I believe that.
Jim, before we get into the Q&As, I just want to take a quick minute. First of all, thank you so much. That was an incredible amount of information that you've downloaded for us. and I'll just give you a break from all that talking while I take a minute. And first of all, I want to thank very much our sponsors that help make this possible today. We have a community partner in the Ottawa Citizen. I'd like to also thank Enbridge Gas, and we would like to thank Media Mall Marketing for their technology support, and of course Welch LLP for helping us arrange to have Jim present to us today. So thank you so much to all of our sponsors. I will just quickly share with you the upcoming webinars that we've got going on right now. So on Thursday, we're going to have practical guidance from an HR perspective and how COVID-19 has affected HR issues. On the 21st, Kingsford Consulting is going to do a webinar called Leading a Virtual Team. On the 23rd, we have Andrea Greenhouse from Vision to Voice Communications. She is going to talk about internal communications, how to talk to your staff and how to stay engaged with them. And on the 28th, we're going to have Stratford managers present the 5 stages of disaster recovery. And finally, on the 30th, we are going to have a little bit of a departure for that webinar. And we're going to look to Steve Cody, Carla Briones, and Su-Ling Ching for their thoughts on leading an organization during the COVID-19 crisis. And I think that will be very inspirational. So now that Jim has had a minute to capture his breath, we do have a couple of questions that were submitted by the chat. So we'll start with those 2, and then we'll open up the floor to questions. So our first question is, what happens if people have already been laid off and they collected the $2,000? Can they now be brought back with a wage subsidy?
It's a good question, Lynn. The program should not overlap. So if someone is benefiting from the CERB, and that's a subsidy essentially $500 per week or $2,000 per month, and that's for an individual who has lost their source of income by virtue of the COVID, that individual should not be eligible for the CERB if retroactively they receive the remuneration that they should have received. I believe the guidance from the government is that that individual, where they're now receiving their remuneration retroactively, should effectively cancel their application for the CERB. I can imagine where an individual has already received a payment for the CERB, that there be a requirement that they repay that amount, because effectively they're receiving remuneration now and they're not eligible for the benefits. One related comment on that would be the notion with respect to business owners and whether or not a business owner who did not receive salary from his or her corporation could qualify for the CERB. And the example I'm thinking of is a business owner, they carry on their business via a corporation, but the remuneration they receive from their corporation is in the form of dividends. They technically would not have that revenue base in 2019 to qualify for the CERB. However, the guidance from the government is where that individual had been in receipt of non-eligible dividend income from their corporation, that they could qualify for the CERB. So I think that could apply to a business owner where their business activity is essentially shut down. They've lost their source of revenue, but they themselves were not compensating themselves from the business in respect of by receiving salaries. Because they've received non-eligible dividends in the past, they could qualify for the CERB.
Okay, thank you. The next question that we received by chat is, somebody is wondering if the revenue is measured on a GAAP basis or is it a cash basis acceptable?
So cash basis is acceptable. And that might be different from the way that a business does their annual financial reporting that would normally be GAAP accrual type accounting. But for purposes of the wage subsidy, a business would be allowed to measure their revenue on a cash basis. So it might be on a cash basis for March 2020. They then have to though compare that to the same cash basis accounting in March 2019. Or the average that would apply for January and February 2020. The one caveat is once they've adopted an approach, they have to use that same approach throughout the throughout the 75% wage subsidy program duration.
Okay, so it's important for them to be consistent in how they're reporting their financials.
Yes.
Okay, great. Our next question, if one applied for CERB and now want to change to CEWS, is this switch allowed? And would they have to bring back all employees or be selective about who is brought back? That's an interesting question.
Yeah, and I think what will happen there is I think there'll be a disconnect between the employer and the employees. And the employer would have to decide what their plan is on a go-forward basis. But if they are effectively bringing back employees who had been laid off, perhaps temporarily, and were not receiving remuneration, presumably those individuals qualified for CRB based on not having income. If the employer decides to bring them back onto payroll, then on a go-forward basis, presumably those individuals would not be eligible for CERB because they're now effectively receiving remuneration again. I think the one area of uncertainty is where the remuneration is retroactive. How would the individuals then treat that income for purposes of the CERB? And the guidance from the government is that there definitely should not be duplication. So presumably where you're getting remuneration retroactively, you'd have to correct your CRB claim and perhaps repay any CRB that's been received. Okay.
Next question, with the 75% wage subsidy, does the employer have to pay the other 25% to qualify?
And the expectation is that employers will pay the other 25%. I think the government is hopeful that employers will make their best efforts to do that. But I think there's a certain amount of uncertainty as to what happens if that other 25% is not being paid. I imagine that we get into some discussion of employment law as to what rights an employee would have with respect to remuneration that it's effectively accrued or promised, but not paid. So that, I think, is an area of uncertainty that employers will have to navigate. But the government's expectation is that the full remuneration would be paid by employers.
Okay. Next question is, what help is there for solopreneurs that still have a bit of a business revenue, but not enough to pay themselves an income?
Yeah, and that's a very challenging dynamic. For a self-employed individual, if their revenue has, disappeared, they don't have a source of ongoing revenue, that particular individual may have access to the CERB. That individual for themselves personally would not have access to the employment wage subsidy because the income they earn directly from their business activity is not employment income. They would have access though to the wage subsidy if they themselves had employees that they were paying. But I think it is a tenuous and difficult area in that this, the wage subsidy program is the most generous program available, I think, right now for the business community, but it clearly has limited application to self-employed individuals.
Absolutely. Our next question is about businesses that have seasonal income. So for example, somewhere like a golf course, do you see an alternative way to assess income loss or changes to programs as seasonal businesses commence their operations? So for example, right now they're basing it on January, February, and March of year, but some businesses are just now preparing for their annual income, but they are expecting a reduced income. So do you think the government's going to go back to the table and relook at that?
It's a very good question, Lynn. I think the way the program is structured and the framework of the program is intuitive, that it's using revenue as the base to determine eligibility. But I think your example, Lynn, of a seasonal type business, also I think of the example of a startup type company that on an ongoing basis has a growing revenue base, but notwithstanding the growing revenue base, they're far behind where they would have projected to have been if we had not had the COVID challenges. I think they're in a tenuous position with respect to the wage subsidy because clearly revenue is the benchmark. I don't know the answer, Lynn, where it's a seasonal business as to whether or not the CRA or the government would further amend or further evolve the revenue benchmarks to contemplate that. You know, and the only thing that's helpful is that it really does allow you to compare to the same period last year. So for example, if it was a golf course and activity in May 2020 really doesn't start because we're still under the COVID limitations, ideally that 30% revenue decline benchmark is met when compared to May 2019. But it is fair to say, or fair to be concerned, that a seasonal business might be impacted by how this revenue benchmark is structured.
Absolutely. Someone else has asked an interesting question. What does best efforts to pay 100% actually mean? And what happens if a company has the cash flow to pay 100% but chooses not to?
Yeah, and best efforts is a very general terminology being used by the government. I think they assume that it's a good faith effort to the extent possible to pay the remuneration. You know, and using a simple example, if you had a pay period and you only have one employee and the amount of salary was $1,000, the employer is benefiting from $750 of wage subsidy. The net amount that would really be funded by the employer to the employee is $250. If the organization, I presume, does not have that financial capacity, the money is just not available to pay the employees, maybe that's acceptable to the government, but where that employer does have the funds available and is not paying the employee, you know, perhaps that's getting into the discussion where that employer is not making their best efforts. I think an important challenge, though, is separate from an employer's obligation to pay employees. There's a myriad of other expenses, including things like rent and property taxes and insurance and other expenses maybe that are difficult to mitigate or avoid as well. So I think it's relatively vague. And separate from that, Lynn, it's not clear to me what sort of enforcement mechanism the government will have. I think they're going to have an assumption of good faith on behalf of employers, but it's not clear to me that they're going to have the manpower to go out and vet the details and to track down organizations that did not effectively pay the other 25% of remuneration to employees. And then separate from that, it's not clear to me what specific rights employees have where they're effectively owed remuneration that they've not received. And then I think all bets are off if an organization is insolvent or bankrupt. Then the government's claim against that company or an employee's claim are probably overshadowed by the bankruptcy type laws.
Right. We have another question, and Darlene, if I'm not explaining your question correctly, please unmute yourself and hop on. The question relates to a business shutting down or working minimally, and they want to know if some employees can be paid with the wage subsidy and others remain on CERB.
I think I understand the question, and I think the course of action adopted by the business, adopted by the employer, will then have a direct impact on the employees. I think the most ideal scenario is the maximum number of employees stay on payroll. They continue to receive remuneration from their employers, and the employers benefit from a material amount of wage subsidy that helps fund that ongoing payroll cost. I think that's, you know, from the government perspective, that's an ideal scenario, and the 75% wage subsidy is meant for that to occur. Separate from that, an employer presumably needs to act appropriately, and they need to manage their financial resources accordingly. And if they do lay off employees because perhaps there's not work for them, or perhaps the business doesn't have the revenue to help fund the ongoing salary cost, I think that individual that's been laid off then presumably has access to EI. And if that individual does not have access to EI, then presumably they have access to the CERB. But I think the course of action adopted by the employer will dictate what options are available to the employees.
Great, thank you. We have, it looks like we have 2 more questions left, and we'll leave it at that for today. So the next question is, as a registered charity, how would one measure if they may have received a grant, but presumably they did not, or they're no longer expecting it?
I think, Lynn, that would get to the notion of best efforts. And, you know, if you were able to extend far enough in the future, you'd know whether or not grant revenue that you were expecting would ultimately be received. It'd be my expectation that if there's an organization and the measurement period is the month of April, that presumably in that period, the charity needs to come up with what its revenue base is. I could imagine where there's material grant amounts that are outstanding, that ideally the charity would try and confirm whether or not that grant money will ultimately be received. And if the answer is no, then presumably that grant amount would be excluded from the revenue base. And then separate from that, a charity in that sort of situation might have a bias to use the cash basis to account for its revenues to determine whether or not it qualifies for the wage subsidy.
Okay. So we have time for one last question, but before I give the question to Jim, I just want to remind everyone that we will be sharing today's recording, and we will be sharing the slide deck. And in the slide deck, I know will be Jim's contact information. So if we didn't get to your question, or if you have additional questions for Jim or any of his colleagues at Welsh, do please reach out to them. So the final question is a follow-up. Could you please clarify, if an employee comes back from layoff, the employee pays all the CERB back and the employer has to show their income from March 15th, or just when they come back? For example, they are on CERB now and they come back next Monday. Tracy, if you're still on the webinar, if Jim needs some clarification on your question, please unmute yourself and hop in there.
I think I understood the question, Lynn. And again, I get into the discussion that there's 2 separate taxpayers, or there's 2 separate entities in question. And first and foremost, the employer will need to decide what they're doing from a remuneration perspective. And if they are paying employees retroactively, presumably that information would be available and known to the employee. And then I think the onus would be in the employee to correct their CERB reporting. If they've benefited from CERB payments, but they're now effectively receiving remuneration retroactively, presumably that would claw back their eligibility for the CERB, and they should amend their claim and they should repay any funding they've received. And I think, you know, the government website and the government, they have frequently asked questions with respect to the CERB and the Canada wage subsidy. I think they discussed that notion in there, but you know, the essence is that there should be no duplication.
Okay, fantastic. And that has taken us to 11:59. What perfect timing. So on behalf of everyone in the Ottawa Board of Trade, I would like to thank Jim McConnery and Welsh LLP for taking the time to help sort this out for us today. A lot of information has been shared by Jim, so please watch out for the webinar link when we send it out, as well as a copy of his slide deck so you can refer back to it. Jim, thank you so much. What a great job you did. Really appreciate it.
You're welcome, Lynn. I was glad to share insight, and thank you everyone for attending the webinar.
All right, everybody have a wonderful afternoon. Thank you so much.
Bye-bye.